Hey everybody, if you're watching this, you are probably well aware that we just executed a very successful trade, and I will preface this video with a few things. So firstly, this is not an I told you so video, but rather a reflection on the trade and the extremely rigorous analysis that went into it, as well as just being a comprehensive video that people can learn from. So I'll be going over all of the components and parameters that went into this trade in a predictive capacity, as well as briefly talking about the algorithms that I built that were involved in this trade and my research. So secondly, there is going to be a lot of content that I'm cramming into this one video. And I don't want it to be too long, but I'm also explaining research that I've done over the past few months, and we'll be integrating that research into the video so that you can see the applications in real time. And I will be showing you how I'm quantifying conceptualities, and that ultimately at the end of the day is what building algorithms in the stock market is: quantifying conceptualities so that you can build strategies around quantified parameters. So not everything will get as explained in depth as I'd like to or could, but I could do so in a future video if that is in the interest of the people. So without further ado, we're just going to get into the video. To start things off, I'm going to reinstate what the trade strategy was and what it was based on. So it was a four-legged option strategy on Tesla, commonly known as a strangle. Now, what is a strangle? Well, firstly, you need to understand a straddle. And to understand a straddle, you need to understand nonlinear evolution derivative instruments. So what is a nonlinear evolution derivative instrument? So we're going to use Tesla as an example. So let's say you buy one Tesla share at $300 and it goes to $400. How much are you going to make? $100, right? So your profit path is going to look like a straight line. And yeah, that's your profit path if you were to own one Tesla share and it went to 400. Now, if you bought an option, a call option, when Tesla was 300 and it went to 400, that profit path is going to look a lot different. It's going to look like this. Nonlinear, it's developing exponentially, and these paths can develop exponentially, logarithmically, quadratically, everything but non-linearly, and that is because of all of the components that make up how options move. Now, I cannot explain that in this video. It's a lot, but you will see a lot of parts of it in this video. So I would highly recommend, if you are trying to learn about these things, to watch this video through, because this is probably going to be one of the most applicable and in-depth videos you're going to find on a lot of I guess just higher level things in the stock market. So to explain a straddle, now that you understand how options evolve, picture Tesla. This is the price of Tesla. It's stuck in a range, okay? This is 400, this is 300. It's not breaking either side. Now, what you're betting on is that it breaks either side, and it doesn't matter which side it breaks. That is what a straddle is, and because options evolve non-linearly, the gains on one side of the straddle will outweigh the losses of the other side. So the side that you lose on evolves logarithmically, and the side that you win on evolves exponentially, and the gains on this side outweigh the losses, so ultimately you end up walking away with profit, and that is what the strategy looks like. So now you can integrate a directional bias. So let's say in the case of this trade, I thought Tesla was going to go up, so I put a lot more money on the call side, and it worked out very well, as you can see. So now that you know what the trade was, how it was deployed, and how it works, we're going to go a little more in depth. So I'm going to be talking about the 5 biggest components that went into this trade, and those were implied volatility, gamma concentration, microstructure, volume profile, and kurtosis. Now I'm going to go pretty in depth on these components, and I will be introducing one of the algorithms which highly revolves around kurtosis and the idea of quantifying periods of price consolidation in low volatility regimes, and I will also be talking about quasi-oscillatory stochastic processes within nonlinear evolution derivative instruments and its involvement in this trade. So with that being said, we're going to get back into the charts, and I'm just going to start going over all this stuff. So firstly, I'm going to start with explaining quasi-oscillatory stochastic processes in a way that anyone can understand it, as it's really going to be an important component into everything else I'm going to be talking about. So firstly, we're going to break down each word and term. Let's start with oscillatory. Oscillatory, think of a sine function. If you don't know what a sine function looks like, it looks like this, okay? Up and down oscillates in a pretty much perfectly repeated up and down process. Now, by quasi, think of something as almost or sort of, and it moves like a sine function, but not a perfect sine function. But at the end of the day, it looks like one, right? And that's basically what it means by what I'm saying, quasi-oscillatory. And stochastic processes is really just another word for a random process. You don't know what it's going to do. It's random. It's a random process. So when I say quasi-oscillatory stochastic processes, this is what I'm talking about. Something that moves like a sine function, but not exactly. And the short-term noise is where you kind of want to build your strategies away from, and rather focus on these points where you know that it has to get to at some point. Mean reverting process. If you think of a distribution curve, here's the average. If you're at your tail end here, where you're low, like where an event has a low probability of taking place, it's always going to come back to the middle. That's just how mean reversion works, and that is really what I really like to revolve my trading strategies around. Something that is certain in the future. Sometimes I'm not sure exactly when, but it'll get there at some point. And so you're gonna see this come up a lot where I talk about tail end statistics and probability. So now that you understand what quasi-oscillatory stochastic processes are, we can start delving into what is called kurtosis. Fun really starts, and you can get to see how I'm integrating probability, statistics, math, and these algorithms, and also just quantifying conceptualities, and I'm going to do it right in front of you, hopefully in a way that you guys can understand. So, kurtosis. What is kurtosis? So, kurtosis is really a way of quantifying risk, and specifically tail risk. So when I say tail risk, think about we're going to think about this in the concept of apples, okay? Something easy. So you have a distribution curve, and we're going to think about the size of apples, okay? So your average apple is going to be, let's say, 3 inches in diameter, okay? 3. And the biggest apple you can find is 5 inches in diameter, okay? And the smallest apple you can find in diameter is 1 inch in diameter. So most of your apples are going to be 3 inches in diameter, right? And if you're familiar with calculation, you take the integral, you find the area of the area underneath the function, and this is how many apples basically have a diameter of 3 or around 3. Now that's a little extra, but when I'm talking about kurtosis is measuring the risk of how many apples have a diameter of 5 inches in diameter or 1 inch in diameter. Now, obviously, there's no risk associated with apples, but we're going to pretend there is, okay? So this is what you would consider a normal distribution curve, okay? And what you need to understand is high kurtosis and low kurtosis. What is the difference? So a low kurtosis is going to be something where the probability of you finding an apple that has a diameter of 1 inch or 5 inches in diameter is low. The probability of finding apples this diameter is low, okay? Now, that means it has a low kurtosis, okay? And now we're going to draw a different distribution curve. It looks the same, but the risk is significantly higher at finding an apple that is 5 inches in diameter or 1 inch in diameter. And you can see that with this gap, there's a bigger area under here, meaning there are more apples with that diameter, okay? So now that you have a rough understanding of kurtosis, this function right here has high kurtosis, okay? High kurtosis and low kurtosis, okay? And now what we're going to do is we're going to relate that to the stock market, okay? So this is Tesla, and we're going to take this area, okay? And we're going to turn this data set of price into a distribution curve, okay? So you have a distribution curve here, and your average price looks to be around right here, right? So let's just say 330, okay? Your average price is 330, okay? And your tail ends are going to be here, so 365, that's your tail. These are your tail ends in this range, right? And what is your tail risk on the other side? It's going to be around 270. We're just going to round down. Well, let's just say 275. So this is your data in a distribution curve now. So you have now started to quantify conceptuality here. And what we're trying to do here is quantify consolidation. And there's a number of ways you can do this, and this is one of them. And usually you have to integrate it with something else, like Bollinger Bands or Keltner channels. And we're going to get to that. But firstly, I'm going to explain what kurtosis has to do with this. So let's say we're just going to pretend this is price, okay? And this has a very low kurtosis. There are no tail events going out of this average. But once you start to see moves that go out of this range, like this, you're starting to get a higher kurtosis. Your tail events are starting to happen more frequently, meaning there is more events, or just there's a higher occurrence, higher probability of these happening. Not necessarily happening, but if you're looking at a data set, there's more of these events, right? And if there are no events, no tail events, that means you have a low kurtosis. So this is what I was working on with my algorithm. I wanted to be able to quantify consolidation periods, and while I was brainstorming, one of the ways I came up with was kurtosis, and this is a low kurtosis. So this tells me it is consolidating. Now, what information does that give me? Well, now we're going to look at Bollinger Bands and Keltner channels, okay? And I think this is where it'll really start to make a little more sense if it hasn't made sense already. So let's pretend price hasn't broken out yet, right? So we're going to replay back to here. Look at how, actually, it looks better on the weekly. So we're going to go to the weekly, and you're going to see that price here, well, these Bollinger Bands and Keltner channels are getting very, very tight and close to each other, okay? Now, what is this telling you? It's telling you that price is basically getting close to breaking out in the simplest of terms. So if you look back in history, when these bands got this tight, what happened afterwards? It exploded, right? It exploded. And this only happened a number of times. This was like one of less than 10 times that this has happened, where we have been in such a low volatility state as this. And I was expecting a breakout either way. And as price developed, I actually became even more bullish based on the microstructure. But essentially what I'm trying to say here is that the bands were getting very tight, and this is another way of quantifying how consolidated price is. You can measure the spreads between these bands, and that allows you to quantify how tight price is. And then when it explodes, the bands expand again. So that is basically the whole idea of kurtosis. And tail risk contagion, that is just kind of not necessarily a measurement, but a concept of when these tail events happen, it kind of causes a contagion of events. So this could bleed into the S&P 500 because it makes up such a large weight of it. this move alone could have caused the markets to go up, or tail risk event could have caused people who have short positions to have to close because they're taking enormous losses. So tail risk contagion is really just essentially saying when these tail events happen, it bleeds out and causes other things to happen as a result of that tail risk event. And yeah, I would say this is a tail risk event here. I mean, if you were shorting, you took a lot of damage here. So that is the first component that went into this Tesla trade. So before I forget, I'm now going to show you guys this algorithm so that you guys can actually see the application of these algorithms. I see so many people making all of these algorithms and they have all these Sharpe ratios, but they've only backtested them and they never actually apply them. They just show you what they look like, they show you a bunch of lines on the chart, and that's all they give you. What I'm going to do is I'm going to show you like the real-time correlations between these algorithms and the stock price and the information it can give you to make predictions. So we're going to run this and so that you can see really just how this algorithm works. So I built it so that you can type in any ticker. So we're going to type in Tesla as that's what we played, right? So it's going to run this analysis. And I'm still working on this part, ignore this. But so this is what we want to focus on. So we're going to blow this up and we're going to take a look at this. So you have kurtosis. So essentially what I did was I took kurtosis and I transformed it into a scoring system, as well as the Bollinger Bands and the Keltner Challenge, which I just showed you guys, right? So this is basically, think of this as each one of these components has a score and they add up to 100. And when it has a high score, that's good, okay? So so the yellow line is the kurtosis score. So it's actually been higher than it was, but that's only half of the algorithm. The other half of the algorithm is catching or measuring regime shifts. So what that means is Tesla has two states in terms of volatility dynamics, okay? It can be highly volatile and it can be not very volatile. And I'm measuring those as two different states, low volatility and high volatility. And this detects when it shifts from a low volatility state to a high volatility state. In other words, a regime shift, a volatility regime shift. And when that regime shift happens, it, I guess, alerts the breakout. That's not really the word I want to use, but yeah. So this is definitely a process that can be transformed into a systematic process. There are very clear probability and probabilistic and mathematical parameters here. So this is something I'm probably going to be spending a lot of time working on and developing, and it has already worked once and very, very well. I actually sold some of these profits and got myself a Camaro just 2 days ago, and that's not just because this is the one play that is done good. I've been consistent all year and the last year, and yeah, but that just goes to show you what you can do when you apply all of these different fields and integrate them into just an integrated process. You take math, probability, statistics, and then there's a whole other world of just finance and understanding all of these other components. But this is what I wanted to show you guys, the real applications of building algorithms, quantifying conceptualities, and actually doing something with it, and not just making some post where you made an algorithm with a good Sharpe ratio that hasn't been tested live and has only been back tested. So this is the real application of an algorithm, and this is what that looks like. Okay, so now that you're familiar with tail risk distribution curves and you have at least some sort of an ability to visualize probability, we can now talk about implied volatility. So I've briefly mentioned volatility and now I'm going to explain it. So it's quite a basic concept. It really just means how much something moves in regard to some sort of average or mean. So if you think of Tesla, Tesla moves a lot. It's very volatile. And on the flip side, if you think about Berkshire Hathaway is not volatile. It's a stable asset. It's diversified, so it's not volatile. It's a very slow trending asset. It's not volatile. So before we get into implied volatility, I'm going to show you guys a few gems on probability and what a 1% difference makes in the context of having probabilistic edge, where in the financial markets, having any sort of edge is really what you're striving for to be profitable. So we're going to go into this, and this is something I coded up to basically simulate a coin flip. Now, the probability of a coin flip is 50-50, right? So we're going to run that, and while this is running, think to yourself, what do you think this is going to look like? It's probably going to be 50-50, right? So this here is a Monte Carlo simulation where you're running hundreds of thousands of paths. In this scenario, we're running 200, and per each path, there are 1,000 bets per simulation. So you can see here, this thick black line is the average path, and it's pretty much break even, right? You can see the distribution, pretty similar amount of, I guess, losing or winning bets, and this is that distribution curve. It's very symmetrical. So now what we're going to do is we're going to change this probability to 49%, and so it's not 50-50 anymore, and we're going to see how that changed the data. So while this is loading, think to yourself, what is it going to look like? So now it's very heavily skewed to the downside, and in the trading world, you have to think about the long run, not the short run. So this is only 1,000 bets. Think about 2,000, 5,000, 10,000, 20,000, and so on. If you're running high-frequency trading algorithms, you're trading who knows how many times per second. These trades are in the literal nanoseconds, and so you're running millions, billions of trades per day with these algorithms, and probability is everything in these markets. So if you have any sort of downside skewed risk, it is just not efficient to run that. And if you were to run 51%, logically, you can probably guess what it's going to look like. It's going to be opposite of this. And that's what you get, upside skew. So now that you understand probability even a little more now, we're going to go back into Tesla and take a look at implied volatility and visualize it. So this is the options chain on Tesla, and we're going to go into the option statistics, and we're going to take a look at the IV percentile. So this is basically a distribution curve. Picture you grab this and you pull it up here, it's now a distribution curve. This is the middle, these are your tail ends. So when we bought Tesla, we bought it when it was under the 10th percentile, which is at basically the extreme tail end. And to visualize that, we're going to look at this is it. This is literally implied volatility visualized. So this is when it was getting into those tail ends we have been talking about so much. And when you get into these tail ends, price always reverses. Always. You can't have implied volatility drop this low and the dynamics of the market just continue doing whatever. Something has to change. It's an oscillating process where, it oscillates. That's how these things work. It's a quasi-oscillatory process. So when you get to these extreme highs and these extreme lows, you should have some sort of mindset that mean reversion is going to happen. This is going to probably trend back to the upper side, or at least back to the mean, the average. And that is what happened here. We bought at the extreme low side, and so we made profits on directionality and vega, or implied volatility, running up. So if you really want to think about this in terms of how you can benefit from options, well, first I want to explain how you can make money on this on the reverse side. So volatility arbitrage. What is volatility arbitrage? It's basically where you are profiting off of missed pricings in implied volatility. So you can take a look here. When we had this gigantic fall, implied volatility ran up to 120%. And if you sold options down here with a delta neutral strategy, so your only exposure is theta decay and vega and implied volatility, you could have made a lot of money, because for every percent change in implied volatility, the options change by the vega value. So if your vega is like 0.17 and the implied volatility falls by what is this, like 60%, you're going to multiply 60 by 0.17 and you're going to get whatever that is, and that's a lot of money if you are selling a lot of options. So I don't want to spend too much time on that, but if that's something you're interested, you can definitely look into that for yourself. It can be a incredibly lucrative strategy if you can think logically in a probabilistic way. So now that you understand what implied volatility is, whenever the market contracts, you're going to see implied volatility drop. And so when we were stuck in this range for like 3-4 months, I was like, it's going to revert at some point. I don't know when, but it's going to happen at some point, and that's what happened. So now that you understand implied volatility a little better, we're going to get into the microstructure as well as looking at the gamma concentration. So last but not least, we're going to be looking at the microstructure, which is the literal structure of price evolution and the mechanics of how a structure affects price in a forward-looking sense. So we will also be discussing gamma exposure, which has to do with the options and derivatives market. And the effect that the options market has on the markets is actually quite significant, and you're going to see what I mean once we get into the charts. But I will also be talking about how microstructure directly affects market maker positioning and the decisions they have to make and what that causes as a result. So we're just going to get back into the charts, and we're going to start off with the volume profile. So what is the volume profile? This is representing volume on the y-axis as opposed to the x-axis. So if you look at the volume down here, this is representing volume on any given candle. So these are the daily candles, and you can see how much volume is being traded in this candle right here. So on this day, it is 292.82 million shares were traded on this given day. Now, if we look at the price, so a good way to picture this is just look at this candle, right? Now we're going to look over here and look at that ring. So we can see where most of the volume, like where your supports and resistances are on this day by looking at this. So this is telling you where the buyers and sellers are coming in. So your supply and demand. And that's really the key thing to understand. This is supply and demand in a visual sense. So I think a good way to kind of build off of this is I want to show you some posts while we were still in this range. So if we go back to, so when I made that first video, we were in a symmetrical triangle, and this is where I was unbiased, but we started trending up while still maintaining this like structural integrity, and I basically just became fully biased to the upside, and you can read it for yourself. I doubled down on my position, rolled these positions out, and as a result, we started trending up even more. And when we got to here, so this is where we're going to start talking about the options market and the implications it has on the structural integrity and evolution of price. So basically what this is it's a way of visualizing where market makers are positioning their money in the options market. And why is this important? Well, we're going to go back in the charts and we're going to talk about how market makers position in the market. The way market makers position themselves in the market is usually they don't have directional exposure, which means they have delta neutral strategies. So what that means is they have a short position and a long position that are in equilibrium. They have no directional exposure, so they don't make or lose any money if it goes up, and they don't make or lose any money if it goes down. Now, if we go back to the beginning of the video where we talked about how price evolution is nonlinear, it's exponential, right? So if price goes up too much, that positioning they have, that equilibrium breaks because of this exponentiality behavior of options. So what they have to do is they have to delta hedge. and that can mean buying shares or shorting shares, selling shares, to maintain the delta neutrality. So this might be a little difficult to understand, but we're going to go back to this next post, and I specifically talk about the fact if we can break 363 to 367, market makers should start delta hedging, meaning we squeeze very, very hard. And what happened once we broke 363 to 367? And why did I say 363? Well, if we look over here at the volume profile, this is really where this supply zone ended. It was actually more like 457, but I think I was saying 363. I mean, the volume profile changes as price evolves too. So at that time, 363 was a big region. Just this region right here. We broke it. What happened? We squeezed because these market makers fell out of their delta neutrality positioning and had to buy shares to get back into a delta neutral position. But what does buying shares do? It causes it to go up more. So they have to buy more to maintain delta neutrality. It is this self-exacerbating effect, and at the same time it squeezes out short position. So that just adds fuel to it, and then you have retail chasing, you have systematic positioning, closing short positions and buying if they're running like trend following strategies. The mechanics of the market go so unbelievably deep beyond just like support and resistances. There are so many underlying factors that play into every single one of these kind of moves. And I want to go back to when I was talking about these delta neutral strategies. So why do they do that? Well, what they can do with these strategies is, so let's use an example. So right here, this was a really good time to run a delta neutral strategy because there's no wild swings, low kurtosis, no tail risk events, significant tail risk events. So they run these strategies where they're betting that it stays in a range, okay? And why do they do that? Well, one of the factors in an option is so we're going to go into the options chain and look at theta. So the thing about theta is it's decaying, right? So if you hold an option till expiration, the theta value causes that option value to go down. But who's on the other side of that trade? It's the person selling you that option. And why do they sell you these options? Well, they can make money from that theta decay. You lose money, they make money on this theta decay. So that's where this major difference is. And that's why they run these delta neutral strategies. They sell these options and they make money from the theta decay. It's called theta harvesting, and that's probably one of the biggest strategies that these market makers deploy. So I'm not really sure where I was going with that, but that's what these gamma exposure levels have to do. And when you break significant ranges and they're forced to reposition, you see these gamma levels start to, so it used to be down here, and once we broke 363 to 367, they had to roll all of those positions up and reposition, and that's what caused this squeeze. And I knew that was coming. Like, I literally said that the day before it happened. The next day, 394.401 will give us resistance, as that was a major gamma exposure level. We had price imbalances there, and yeah, and we got to 420, which was my main target because of a few things. So we're referencing Elliott wave theory. So in Elliott wave theory, it's basically just this concept that price evolves in wave structures, so waves of 5 and 3. And this was the structure that I was looking for. If you go back to my last video and watch that, I specifically alluded to the structure in that this gives a higher probability of price breaking to the upside. And how do you measure these targets? You take a Fibonacci extension from the low to the next high to the next low, and it gives you this target. And I mean, you can see it for yourself. That's basically where we topped, for now at least. I still think there's a chance of 440 to 450. I'm not betting on it, but it's a possibility. You have a price imbalance there, so that remains a target until some other factors. So yeah, so that was how I arrived at this main target of 420. I closed my positions there, and now I'm waiting. And I think we could see, I'll talk about that in a little bit, but I want to go to Apple, and I want to show that this was the same strategy. This was before Tesla, and this was also in the algorithm. So this is the same thing I did for Tesla. Now if we go to this breakout 805, 804ish, and we go to Apple and we look at that range day, August 4th to the 5th, or what did I say? Yeah, August 4th to the 5th. That's right here. What did it tell me? It's that regime is shifting, and I was specifically all the way back in August. I was specifically alluding this is a really good area to enter calls if we get there. Well, to enter the strangle, because there was a low chance we could have broken to the downside, but I was very biased to the upside, and what happened? It exploded because Kurtosis started to contract. Those Bollinger Band, Keltner Channel started to contract. The same setup as Tesla, the exact same setup, just a different structural development, but it was the same concept. So again, this is the application of an algorithm and these quantifiable parameters. So I explained the Elliott wave, the market makers, volume profile. There really isn't too much more to say. I really think I've given you guys more than enough to learn from and work off of. I think I'll end it where I think we go from here. So I do think there's a possibility we get to 440, 450, and there's actually a minor chance we can maybe make a push for the 500s. And I'm done betting on that. I'm going to be looking elsewhere for trades. But if we do top here and we remain here, and that is confirmed with a MACD crossover, which is basically just looking at the change in rate of change of moving averages, we could start to look for downside, and I would be looking for us to move back into this range where this used to be a supply zone and will now be a demand zone. So we come back here, we test this region, and again, this is like a distribution curve. So we're going to be looking at the front end of it, the back end of it, and most importantly, the median. So you have support, and if you break that, you're looking at the next volume node in the volume profile, which is 280 to 270. So it's nowhere near ready for that setup yet, but I figured I might as well just end it with where I think it'll go from here. So nothing really to trade off of, but that's going to be it for this video. If you have any questions, if you want me to talk about any of this other stuff more in depth, please let me know in the comments. And yeah, we'll end it there.